I'd love to welcome Akil. Just a quick bio for some of you guys who don't know much about Akil, but Akil's been working with Philip J. Anderson for over a decade to produce unique research that combines an in-depth understanding of business, real estate, and the stock market cycles. Akil became interested in economic cycles during his school years when he came across Henry George's Progress and Poverty, which explained why economies, through periods of boom and bust, later on, he witnessed the negative effects of not understanding economic cycles when his family business went through some difficult periods during recessions in the 90s and in the GFC 2008. He became determined to develop a body of work that would help people, whether they were investors, business owners, or those who were just interested in doing something with their savings to grow their wealth or to manage their affairs through courses of economic cycles. So Akil has professional experience in audit, central government, and international banking, and has worked on a range of issues from reviewing large infrastructure, public-private partnerships deals to helping establish UK's $3 billion international climate fund. He has 2 master's degrees in finance and public policy and a first degree in the classics from Oxford. He is also currently a principal policy advisor to the European Bank for Reconstruction and Development. Wow, that's a pretty decent bio. So please give Akil a very warm welcome, and over to you, Akil. Thank you for joining us.
Thank you very much for having me. Thank you. Well, look, I'm delighted to be here. It looks fairly bright in my study. It's just coming up to 6 o'clock in the morning in London, which is where I'm joining you from. But I'm happy to talk about cycles and markets any hour of the day. So even if this was midnight, I would still be more than happy to do it. I'm going to give you, and I appreciate that all of you are day traders and probably look at markets from a relatively short-term perspective, just from the point of view of entry and exits on your trade. And I've done a bit of day trading myself. And, you know, it's, I think, very useful often, even in your trading, to have an understanding of where it's all headed. And that's what I hope to be able to give you today. For those of you who weren't at my presentation this time last year, I'm just going to do a bit of an overview and then talk about kind of what I see as the kind of key issues for the markets and the economies as we move into 2022 and indeed beyond. As Cam said, I'm Akhil Patel. I'm director of an organization called Property Share Market Economics, which I set up a couple of years ago with my friend Phil Anderson. I'll mention a bit more about him in a couple of seconds. Now, the big thing to understand about our economies, and when I say our economies, I'm really talking predominantly about Western economies because we have the longest period of history for them, is that they move in 18-year cycles. And in his introduction of my bio, Cam mentioned that my family's business had gone through some pretty significant difficult times in 2008, like a lot of families in post GFC, but also in the early 90s. And it was around that time that I thought, well, why are people not joining the dots? And that's where I came to sort of start studying cycles and so on. And what I discovered is that in the UK and the US, and indeed in Australia, for probably around 200 years, there's actually a pretty stable pattern where you have a major crisis and then the economy resets. And even though there's a lot of fear, you tend to get a recovery and an expansion. And after a few years, that expansion looks pretty good. And that sort of expansion lasts on average around 7 years. And then often, once things have maybe gone slightly over the top, you get a relatively minor recession. And what the minor recession does after a few years of expansion, it gives everyone the impression that actually, even though there are sometimes difficult periods in the economy, actually, the government can manage the economy. People, banks and businesses can survive the recession more or less, particularly if they haven't done anything silly in the prior expansion. And that sets the scene for a second expansion, which is much more confident, much more euphoric, people are jumping into the markets in a much greater way. There's more money sloshing around. And the second 7-year expansion is much bigger, it's more speculative, and eventually ends up with a period of about 2 years of mania, which in this diagram I've called the winner's curse phase, where things are really going over the top. You see really extravagant behavior, and at some point the economy can't take it anymore, frankly. It's just, things are getting too expensive, asset prices are going too high, people are borrowing too much money, all the kind of behaviors that we saw in the run up to the global financial crisis in 2008. And once that happens, you get a peak. And then you get a major recession. And so essentially the economy goes through these periods of expansion and contraction. The expansions are about 14 years, and the major crisis at the end after the peak is on average 4 years. And it's a really significant recession. And it's partly significant because things have gone so over the top during the second half of the cycle, the second expansion, but also because when it comes down, it brings down the banking system. And when banks are brought down, they can't lend money to businesses. And so what might have been a minor correction in the markets actually ends up being a full-scale economic depression. And so you have, and the reason why it takes 4 years to kind of get through really is because, it takes 4 years to sort out the banking system. And so this is a sort of 18-year cycle. Now you might think, well, that sort of sounds funny. It's maybe if you haven't heard this before, and also it might seem a bit too regular, but actually if you go back over history, you will see its regularity, and you can kind of trace it in the United States from at least 1800, in the UK probably even longer. Australia, of course, in 1800 was still, shall we say, still had its best days ahead of it, and started to pick up the cycle some way during the 19th century. At some times following the cycle in the UK, at other times following the cycle in the US. After the Second World War, most Western countries got tied to the US cycle because the US was, of course, by far the largest economy, and still to a certain extent is the largest economy, and certainly the economy that for the time being runs most of the show across the planet. So that basically is the big picture, is economies move through 18-year cycles of boom and bust. Now, the obvious question is, we've had a pretty interesting couple of years. Where are we now? Have things changed as a result of the last 18 months lockdowns and pandemics and all the rest of it? And my answer to that, and we can talk about it a bit further in the Q&A, or also in some of the slides that come later, is actually no. The pandemic hasn't really altered anything, and I'll show you why. So if I'm right in my kind of thesis that there is an 18-year cycle and that's continuing, 4 years post GFC took us to around 2011, 2012. And if you can remember that far back, at least if you were in Europe, you would have been very aware that we'd just had the Eurozone crisis. It was probably when the news was at its darkest, even though, stock markets were by that point starting to move up again. So the start of this current cycle is around 2011, 2012. There's no one day when the cycle starts and ends. You've got to kind of work out a sort of a period of when you're going from previous crisis to recovery of the next cycle. So if 2011, 2012 started the cycle, then 7 years in, around 2019, we would be expecting a mid-cycle recession. And in fact, we got exactly that. I mean, the global economy was very much slowing in 2019 if you knew how to read the economic signs. One of the indicators that I use is the inversion of the yield curve, which did so in 2019. PMI and other kind of economic data was suggesting we were coming to a slowdown in 2019. Of course, we then had the pandemic on top of that. Now, I'm not going to get into whether it's real or not. I mean, in some senses, it doesn't really matter. I mean, people were fearful, governments felt compelled to act, and what they did is they told us to lock down. What ended up happening is a very sharp but relatively short recession during 2020. In fact, on some measures, possibly the shortest recession in US history took place at the start of 2020. Of course, it was severe for the moments when we were told to be stopping our economic activity. And once we were allowed to open up, as we have been in the UK and the US for some months, things recovered pretty quickly. So we've, I think, been through our recession, and we're now at the start of the second, more speculative half of the cycle. And if I'm right in my thesis that the cycle has continued and it's not been altered by the pandemic, then we should expect a peak around 2025 and 2026, with a period, the 2 years prior to that, being the really kind of crazy 2 years of speculation, people borrowing too much, and kind of all the things that are associated with an investment mania. Now, you might think we're already in that now, but actually, if it's my answer to that would be, if it's like this now, can you just imagine what's going to be coming around the corner in a couple of years' time? And if that's the case, you will have then, after 2026, a period of pretty significant recession and depression, when things will look pretty ugly, I suppose, for the 4 years into around 2030, at which point, when the news is the darkest as it was in 2011, you will have the start of the next cycle. Now, I appreciate that the experience of individual countries within this overall picture is slightly different. And if you're in Australia, of course, in 2011, things were probably looking not bad. I mean, China was, to a certain extent, booming because of the stimulus that it put in place after the global financial crisis. And of course, that pushed up demand for raw materials, which is, generally very positive for the Australian economy. But even nonetheless, in real estate terms, in tertiary and secondary cities, it was pretty significant downturn in the real estate market. If you were trying to start a business in certain areas, it would have been pretty difficult. Banks would have been quite wary of lending to you. It's probably only Sydney and Melbourne that really had a very significant price appreciation. And so, you can fit the overall picture onto the Australian market as well. And certainly it's Western economies, by which I mean the US and the UK and Eurozone, have experienced the cycle, at least for the first half, as you might expect, based upon my overall thesis. This is just some of the historical data, which I don't need to go through now, but more than happy to come back to it. But this is just to say, this is a graphic of land sales in the US during the 19th century. Just so when the US was settled, when the frontier expanded westwards, the US government sold off its land and enabled a lot of people and companies to speculate in real estate. So it's a nation founded in real estate speculation, if you will. And what you tended to find is you'd have a period of relatively steady growth in terms of land sales, and then a few years of outright sort of speculation. A lot of land sales took place up into around kind of 1818, 1836. So you're kind of seeing this 18-year periodicity in the US in the 19th century, 1854, 1869, slightly early, but actually the financial crisis at the end of it. And there was, after each of these peaks, a major recession or financial crisis, banking crisis. The one after 1869 was in 1873, which is 19 years after 1854, and so on, 1888, 1908. And so for the entire first century of the existence of the US, you got an 18-year cycle. Of course, the next one after that was the boom into 1929. The Roaring Twenties fundamentally was a land boom, a land speculation period, which went to probably the biggest period of expansion in history. Then we had the Second World War, and after the Second World War, the kind of Western economies reset at the same time around 1955, late 50s, after reconstruction of Europe and demobilization, all the sorts of things that happened. And after that, we had a period of steady growth and then a crescendo in the early 20s into around 1973. Then another speculative peak into around 1990, 17 years later. And while it was big in the UK and the US, it was most spectacularly seen in Japan, which had one of the biggest real estate bubbles of any country of any period. And it was reputed that the value of the land under the Imperial Palace in Tokyo, because property prices had got so high in Japan, the value of that land under the Imperial Palace was worth more than the land of the entire state of California, which gives you a sense of how high that bubble reached in those periods. In fact, quite interestingly, an enterprising government official in Australia sold off half the land in the Australian embassy in Tokyo I can't remember the exact number he sold it for, but it was worth fully half of the entire external debt of Australia. So it was a really good idea to pay down 50% of Australia's external debt just by selling off half the land in the embassy in Tokyo in the late 80s. So it was a brilliant move. Anyway, I digress. After 1990, of course, early 90s, this is when my family's business experienced a very significant kind of period of difficulty, financial difficulty, partly because banks were collapsing and withdrawing lines of credit from small businesses, which is one of their responses to a major financial crisis, which is why they're so severe, because small businesses generate the most employment in an economy. Anyway, things recovered in the early 90s to the peak around 2006, 2007, and then we had the global financial crisis. So that is a very quick whistle-stop tour of the historical evidence behind the 18-year cycle. I mentioned my business partner, Phil Anderson. He documented the entire history of the real estate cycle in his book, The Secret Life of Real Estate and Banking. And he draws out very much all the kind of key developments that take place over the course of 18-year cycle, and is able to demonstrate, cycle after cycle, how similar things occur. And if you understand the basic underlying rhythm of the cycle, then you can use it to forecast, which is what I'm going to do now. So I actually developed this chart in 2016 for a presentation of property developers and property investors in London, and we had representatives from JP Morgan, and so everything on this graph other than the yellow dot, which is kind of where we are now, is the same, and it's just basically understanding the underlying rhythm of the cycle, and you can use it to forecast. So in 2016 the yellow dot was a bit further to the left. We're now in 2021 starting the second half, as I've mentioned, and what tends to happen after the a recession is governments lower interest rates, they loosen monetary policy, and they start loosening the purse strings in terms of investment and in terms of providing money to the economy, in terms of welfare and other things, other programs. That is exactly what we happened. Even though I kind of predicted this in 2016, late 2020 is exactly what we got. And allied with that, and this is particularly true of the second half of each cycle, is there is enormous amount of infrastructure spending. And that's partly because, it takes a few years of an expansion of a cycle for the government to see that, technology's moved on, people's working and living patterns have shifted, and there's a new demand for different types of infrastructure. So whether it's new forms of energy, it's new forms of transportation, building rail links, it's cleaner energy in this era. It's the rollout of 5G and all these other things that we all need to function in the modern economy. The government realised it needs to be done, and pledging huge amounts of infrastructure investment is a great response to recession. And we have seen both government spending and the intention to invest in infrastructure on a really grand scale over the last few years. For example, the US is planning to spend at least $1 trillion in infrastructure investment over the next few years, and probably will pass an even bigger package if they can get it through the Democratic wing in Congress. A similar, not quite the same scale, but similarly big in relation to GDP pledges in the UK, in the European Union. I noticed that Australia launched its infrastructure plan to 2036 relatively recently. There's an enormous amount of investment going on. It's not just in advanced countries, also in Africa, in lots of Asia, in Russia, and so on. So I think all of this is incredibly bullish for the second half of the cycle. And of course, what infrastructure brings is a major boom in commodities, because there's demand for raw materials. And of course, that will then be very significant for countries like Australia that has plenty of all of that. As the economy expands, banks continue to lend and increasingly do so. And one of the reasons is the mid-cycle recession never ends up being a banking crisis, because you haven't had the real speculation, particularly in real estate, of the first half of the cycle. And so banks think, well, we're in pretty good shape. We can pass all of our stress tests. We can stick to the regulations and lend a lot of money. And they do so in great quantities. which at first pushes the expansion higher, which is why the period of higher growth. But then after that, it goes way over the top. And they're really trying to loan as much as they can, and you get calls from your bank manager asking you to take on loans and all the sorts of things we saw up into the peak of the last cycle. And one of the reasons why that we're getting over the top is that someone somewhere has conceived of the world's tallest building, and it is announced in this period of outright speculation. And in 2005, I believe it was, or maybe it's 2006, we had the announcement of the Burj Khalifa in Dubai, which was at I think it's kilometre high, or maybe it's 1.6, can't exactly remember. By far and away the world's tallest building was announced. But if you go back to previous cycles, for example, in the early 70s, you had the Sears Tower in Chicago, which was the tallest building then, or indeed in the late 1920s, the Empire State Building, which was the tallest building as well in that era. And then you get to the peak, and as I've said, things come crashing down. And during the period of outright depression, you get the point at which that tallest building opens. And of course, because you're in a recession, no one can be found to rent out the space. So it's usually an empty building for a number of years, a bit like the Empire State Building, for example, opened during the Great Depression, and for the first few years was known by New Yorkers as the Empty State Building, because no one could afford to occupy any space there. So that is kind of the bigger picture. I probably spent a little longer than I intended on that. What I now want to cover in the few minutes that I have remaining is what this means for traders. Because it isn't just an economic cycle, it's also a cycle that you see in stock markets. Now, in this graphic, what I've done is I've taken stock market data for the Dow Jones, or the broad US index, from 1800, so over 200 years of data, and I chopped it up into 18-year segments, and I did a bit of statistical manipulation so that you could combine the Dow when it was trading at 80 to now when it's trading at north of 30,000, and I sort of combined them in a way. And what you find when you chop the market data up into this 18-year pattern is a picture that is actually relatively similar to that stylized diagram that I just showed you. You get the first half of the cycle when the Dow is going up, then you get a mid-cycle kind of where the Dow doesn't do much, or in some eras it comes down quite hard and then goes up again. And then you get the second half where the Dow is going up again, and probably even more so, and then you get a peak and crash. And each of these halves of expansion are pretty significant. The Dow doubles, or if not more, in each half. Typically, and not always the case every cycle, but often does. And then when you get the peak and the crash, it's I think the median fall in the Dow over 200 years is kind of 50%. So it's a very significant stock market event, which can be kind of seen tracing the overall 18-year cycle that I've described. And I kind of very briefly, this is something that I spend some time with my subscribers talking about, is within each of the halves of expansion, you can see the regular interactions of different segments of the economy. Now, I appreciate that you're probably futures traders and therefore would mainly focus on the broader stock index futures. Some of you might be trading CFDs or other things, and this might be of more interest. But what you tend to find is a rotation between different sectors. And I've taken this sort of model from Trading with Intermarket Analysis by John J. Murphy, but there are other sort of similar models. And basically, you can find, if you look at the research, that initially the expansion of each half of the cycle starts in the tech and cyclical sector. Then as the economic expansion takes hold, it moves into basic materials and industrial stocks and energy, and then gets into consumer staples. And then you start to get to the more mature end of the expansion. You go, utilities come into their own, people start to get a bit more defensive. And one of the most lagging parts of the sector rotation is finance stocks, because typically they've been battered by the previous crisis, and they really come into their own once the economic expansion is really taken hold, and then banks are more confident about lending to them. So you can kind of rotate sectors as a part of your investing strategy, as well based on this, and you can refine the analysis even further. What might be quite specific to this second half of the cycle, I suppose, are some of the major themes that I've touched on when describing the overview of the cycle. So I mentioned that infrastructure is always part of the second half of the cycle, and I think in this particular cycle, to an even greater extent than we've perhaps seen possibly since the end of the Second World War, when there's reconstruction and there was demobilization, and we were very much into a new type of economy. A lot of people were buying automobiles, and so to build roads, and the way that we interacted around the country changed. Also, the development of commercial air travel and so on. You have a level of infrastructure spending coming, I think, of that order. High-speed rail, internet connectivity, people looking to locate in different places because we can work remotely and so on. I mentioned, therefore, this will naturally lead into a major boom in commodities. I'm going to say a bit more about commodities in a few minutes. Of course, it is ultimately a real estate cycle. It's real estate that is the biggest asset that we have, by far and away bigger than the stock market and the bond market globally, and very much the main attraction of a lot of surplus money. So when you have a major expansion, there's a lot of money sloshing around the world, and most of it ultimately ends up in the real estate market in various places. To acquire real estate, you need a loan typically. So banking stocks have a very strong second half of the cycle, as I've mentioned, and allied to that is fintech in this cycle. So there's a lot of commercial challenges to the traditional banks. A lot of smaller banks can do things much more easily, much more cheaply. It's really truly mind-boggling how easy it is to interact with your bank these days compared to about 10 or 15 years ago when you had to go and stand in a queue in a branch. It's quite sort of ridiculous to think we had to do that. But it's not, this is not new to this era. There's every time you get a boom, you get some kind of technology which is applied to the banking system, which makes things a bit easier or quicker, and in some cases more speculative. So in the last cycle, of course, it was computer risk models that enabled banks to feel they could lend more money towards real estate and then sell off those loan assets to institutional investors, which actually ultimately just end up spreading risk around the system. But in the 1920s, for example, it was the first rollout of telephones, which actually made the settlement of payments much quicker than it had ever been before. And so that really supported the boom of the 1920s. And something that is actually being talked about a lot at the moment in the UK, because we're hosting the Climate Change Summit next month, is our transition to a net zero carbon future. Now, I'm not into the politics of all of that. I mean, I personally think that we use the planet as a bit of a toilet, and so anything we can do to reduce our impact, I think, for me, is a good thing. But regardless of all of that, this is going to be an investment theme for the next 50 years, is really cleaning up our approach to generating energy and how we move and so on. And that will entail trillions and trillions of dollars in investment, and will be a major important factor, particularly in the next few years, but even beyond that. That is kind of how I use the overall cycle to generate kind of ideas for what happens within each economic expansion and how you can, to a certain extent, invest in it. In addition to that, you can use cycles to generate annual forecasts. This is my forecast curve for the Dow Jones in 2021. I should say that I focus on the Dow in particular because I have the best data. And if you're a cycles analyst, as I am, you need long-term data to give you confidence that what you're seeing as a pattern in the data isn't just something that's happened once. You've got to see it happen over and over. But the NASDAQ, even though it's a kind of a more bullish index, because all of the action in terms of the new economy are through stocks that are traded on the NASDAQ, it tends to follow the Dow, shall we say, and so does the S&P 500. And indeed, a lot of developed country stock indexes are fairly well correlated with each other and tend to follow the US. So you can use these Dow forecasts to apply to the markets that you're interested in trading. And I think it's important to say at the outset, the forecast is a forecast. You never trade the forecast. You always trade the markets. You look up for your own trading setups and so on. But nonetheless, when you get particular turns in the market consistent with a cyclical pattern where there is a setup that works for your own trading system, in my view, these are highly tradable events. So what we forecast for 2021 was that we'd have a strong run up into May, that the trend would, in at least according to the forecast, reverse into a low in October, and then we'd have a decent finish to the year, if sideways or a decent finish. Now the Dow doesn't exactly look like that, but it was certainly the case that the trend that really started 2021 stopped around the middle of May, and then we had a period of sideways, not so much in the Nasdaq and the S&P 500, albeit that the number of stocks actually increasing in that period became increasingly narrow, and on certain European indices and some Asian ones and things like the Dow Transportation Index, you very much got a peak in May, and then the market traded down or sideways for the period into October. And it looks like we're now back onto a resumption of the uptrend. It's not yet confirmed in my view, or at least it wasn't at the end of last week. But nonetheless, it's conforming, at least in its own way, to the roadmap that I set out, at the start of the year. And so if you were watching for reversal points at the start of October, I think you would have found one. And so that is kind of how you can translate the big picture into investable moments in the context of a particular market. I'll briefly say a bit about the outlook for 2022, and I'll then finish on something to do with commodities, if I can. So what you tend to find, I think, bear in mind the bigger picture for me is incredibly bullish. But what you tend to find is the early years, particularly just out of a recession, are quite volatile. And of course, if you're day traders, that's going to be quite a good thing, I think. And one of the reasons why they're volatile is because, recessions do affect companies, and there's a lot of negative news. We've just seen one in the last month around the Chinese property developer Evergrande, which actually didn't have a huge impact on Western markets, but nonetheless caused a few murmurs in the stock markets, and of course had a bigger impact on bond markets, particularly high yield bonds. And so you're going to possibly get more of that in 2022, even though I think the underlying picture is pretty bullish. So there'll be talk of tapering, because inflation is now somewhat of a concern across the planet. And therefore there'll be talk of raising interest rates. And, people say, well, is the Federal Reserve now behind markets as it seems to have been over the last year and a half? There's supply chain issues. I'm not sure to what extent it's affecting things in Australia. It's certainly having a big impact in the UK and around the US. And there's, of course, things like geopolitical tensions with China, increasingly assertive in its own backyard, increasingly trying to kind of get Taiwan to rejoin the mainland. Of course, Australia with their submarine deal is now going to be all part of that. So there's going to be a lot of turbulence around in 2022, but the underlying sort of backdrop, I think, is pretty bullish. And I think the final thing I'd say about stock markets, and in particular in relation to Australia, is that because of the demand for commodities, the second half of each cycle tends to be incredibly bullish for Australian markets. They typically get back into all-time highs towards the end of the first half, or in this cycle at the start of the second half. And aside from a few, drawdowns at the start of the second half, they tend to go really sort of gangbusters and probably in most cases outperform US markets in the second half of each cycle. And that's also true if you're a currency trader, for the Australian dollar tends to appreciate against most other currencies because of the demand for raw materials. One final word on commodities, because I've mentioned it a few times. This is a forecast curve for the entire 2020s. Ignore the sort of rather large fall at the start of the decade. One thing you have to do in relation to forecast curves that are long-term like this is you've got to, when you apply it, you've got to look at the context of the times. So the underlying cyclical backdrop to commodities at the start of the decade was not great. And of course, in 2020, we did have a fall in certain commodities for a bit of time, particularly in oil. We will find a low, maybe we've already seen it at the start of the decade, but what I really want to focus on, once that low is in place, and maybe it already is, but depending on which commodity futures you're trading, the underlying trend up towards the end of the cycle is up. And there are a number of reasons which I can talk about in the Q&A if you want to, why this is the case. But across the commodity suite, I think you'll have some pretty significant runs in the markets over up until around probably after the peak of the stock market. Commodities tend to peak later than the stock market each time you get a cycle. And then you get a major sort of downturn during the recession that is forecast to take place in the late 2020s. Okay, I think I've said enough. I will happy to take questions. I hope that was of interest.
Thank you, Akil. That was wonderful. It's great insight. I know you had a lot of information in a short amount of time, so we really appreciate your wisdom and your research. We do have some great questions. Just a quick one with the COVID situation. How do you think that will affect the 18-year cycle? I'm sure it's a big question on a lot of people's lips.
Yeah, I mean, I've had that question more than any other for obvious reasons over the last 18 months. And the answer I give has not changed, by the way, even when markets were crashing in March of last year. So essentially, I don't think it's changed things. I mean, clearly, not every cycle is going to look the same. There's always going to be some new things that take place. And the issue is really the response. Does that change anything? And the response has been huge amounts of stimulus, huge amounts of, pushing interest rates to zero, i.e. lower than they were before, and planning to spend huge amounts on infrastructure, which is basically the three things that we got in response to the mid-cycle recession in 2001, in the early 80s, and so on, is essentially the same sorts of things happening, maybe for different reasons, but it's all coming together. And so what I would say is, I'd always forecast the 2020s to be another roaring 20s, bigger expansion than we've ever seen, more wealth creation in the 2020s than in any other period in human history. And as a result of COVID, I think that expansion is going to be even bigger. So I'm doubling down. I'm just going to say COVID has made things even bigger than it would have otherwise been.
And I think the challenging thing is the amount of media we're getting, the onslaught of media. Do you think that has an effect on people's decision making?
Yeah, usually to do the wrong thing, unfortunately, or to do things too late. So I suppose the main regret for investors is I wish I'd bought then. And the reason why you didn't buy then is because everyone's telling you how bad things were. And similarly, towards the peak of the cycle, it's, this is a great time to buy. You really got to buy now. You're going to miss out. And that's usually the worst time to buy because, the downturn is coming. So the media doesn't help. It's not designed to give you the information that you need. I don't mean that in a conspiratorial sense.
No.
The media reports on an established trend. Traders, you always know that if it's in the news, it's in the price, and so it's not the trade you should be taking necessarily. And that that media works like that, and it's always behind the curve and not giving you the information that you need. And of course, allied on top of that is the huge amount of fear that has been generated around COVID, around the response to it, and that is understandably made people quite concerned about a lot of different things.
So it's best to be an early adopter or in the mass majority, early majority, I should say, when it comes to investing.
Yeah, price charts are objective. You see you actually see what's going on. You see the reversal signals, you see trends. That usually isn't what's being reflected in the news. You just have to follow the trend, essentially.
Exactly. I've got a question from Mark Norton. How do you see China playing out in the thesis given the possible slowdown?
Yeah, China is an interesting one. I mean, it's becoming integrated into the global economy, but it's still not, it's still not really there. I mean, Chinese capital does go abroad, but not in the way that it does from other countries. Its government has a major control over its economy, and so can contain things like the fallout from the Evergrande. I mean, part of that is because the government has been tightening up and trying to reduce lending and other things. So, look, the honest answer is we don't really know. I mean, you can't, there is the possibility that, there is something going to happen which will mean that the cycle doesn't repeat in the way that you thought before. My kind of expectation is actually Chinese will get caught up in this burst of property speculation eventually, and it already has to a certain extent in previous years. And it will, once it gets going, it will really get going. And because people get happy when their wealth is increasing, the Communist Party will have no reason to stop it. So I think the problems for the moment have been contained. I think Chinese will turn around and actually probably in the same way that we might in the West get some confidence that actually the party is in charge and can stop bad things happening. And so they jump in with 2 feet. Eventually in the 2020. So I think China will add to this, but you just have to wait and see and see what develops.
Hope that answers your question, Mark. Now, Malcolm Gibson asks about what about crypto, blockchain, and that type of disruption on the US dollar system?
I mean, so the US dollar settles trades for, 50 or 60% of goods, even not involving American companies. I mean, you'd be kind of slightly mad to use Bitcoin for any of that, not least because, Bitcoin might be worth twice as much in 3 days' time. So, you don't want to get rid of it. Slightly, apologies, that's a maybe slightly flippant answer. What I know from history is there's always something new that comes along to fuel the real estate speculation side of it. I see blockchain as more fulfilling that role this cycle than I do, and possibly the next cycle and the one after that, than I do at the moment supplanting the US dollar. I think the US dollar will be supplanted when there's an alternative global currency that can be used to settle international trade. In previous eras, we've used gold. We've used sterling, because of the British Empire, and it was, the dominant kind of force in the world. The US dollar took over that. If there's something similar, some international institution, or maybe it's China, even though, you probably wouldn't want to be settling trades in Chinese currency with a government so powerful and in so much in control of what goes on. If blockchain, if a type of coin can take that role, then yes, it will supplant the dollar. But it's got a long way to go before that can take place. It's going to be a long time before investors, traders, international business would be confident using such technology to settle trades.
So it's just going to be a time. It's a time matter with those types of newer cryptocurrencies and things like that.
Yeah, possibly, but
a mass adoption.
Well, I mean, these things tend not to be, short and sharp events. It tends to be a process. There was a process by which the US dollar became more important than sterling, for example. There'll be a process by which the US dollar is supplanted. But I mean, the premise, I think, for some of all of this is that, the US dollar, the US prints as much money as it wants, and it's unreliable and so on. I mean, it's not entirely true. I mean, the US dollar and the US government has a very privileged position. But one of the things it needs to do, because everyone is, settling international trade in US dollars, is it needs to supply the world with US dollars. And one of the things that happens during a recession is that the dollar market dries up very quickly. And so the Federal Reserve has to basically flood the system with dollars, or we don't get international trade. That is not a situation which you really want to have. So any international trading system would need, blockchain or a blockchain token to be able to be created in that way so that the wheels of commerce could continue. I think we are some way from seeing that kind of system in place. So I think the reports that demise the dollar are somewhat exaggerated at the moment.
Yes, okay. And I think you've answered this in your presentation, but your view on money printing and the massive spending for the pandemic and debt ceiling. How will this affect the market? Well, it'll just keep
Yeah,
increasing,
the
right?
debt ceiling is always a political kind of nonsense that takes place periodically. But money printing, yeah, I mean, the world is awash in money now. It's not public debt per se isn't so much of an issue. It's kind of how it distorts decisions that people make, and it drives interest rates lower. It sort of, people end up being, I think, using that money to speculate, and I think that's where we'll go. So I think that's one of the reasons why I think the boom will be bigger, because the world is awash in money, and ultimately why the bust will be pretty significant in the late 2020s.
Yeah, brilliant. One from Ashley. Given the amount of government intervention stimulus, do you see the cycle being a lot worse than anything before and retracing sooner than 25-26 top?
Well, when you say worse, do you think it'll be? I assume you mean bigger boom and a bigger bust.
Yes.
Yeah. No, I definitely think it's going to be bigger boom. Will it happen sooner than 2026? I mean, it's possible. It'd be possible that this could be a really short cycle. It'd be probably the first time in 200 years. I'm open to the possibility, but I haven't seen any reason why it would be sooner than that. I think the thing is, it takes a couple of years for everyone to see a particular trend. At the moment we're still worried about COVID, rightly so in some cases. After a couple of years, everyone will see, well, actually things are going on. I should be part of it. Then it takes another couple of years for everyone to be pretty much in the market. It's the markets fall down when everyone's in, and so if that's a 4-year process, that's going to take us pretty much to when I said it would. It could be quicker, but I don't think there's a lot of money still on the side waiting to be invested.
Correct. Now, just a couple of questions on property to finish off with, Akil.
Yeah.
What are your thoughts on residential property investing in Australia, buying and building now and holding through to 2026, or sell out in that period?
Yes, it's a good question. So what you tend to find in most property markets around the world is the first half of the cycle tends to be concentrated around the really big cities and the center of cities. And then in the second half, it kind of spreads out. And in fact, the markets in other cities tend to go a bit stronger than the central ones. And so Sydney and Melbourne typically first half much stronger. Second half, it's some of the other capital cities and smaller towns in and around other cities. And of course, if you've got a commodities boom, as I've forecast, Western Australia and so on tends to do relatively well, Perth and other things. So I expect that pattern will hold this cycle. It holds in the US. We're certainly seeing signs of that outside of, say, the major cities of San Francisco and LA and New York, which were the leaders in the first half. In terms of buying and holding, I mean, I personally wouldn't want to overreact in terms of selling everything in 2026. I mean, I'd make sure I'm protected. If my stock portfolio is either hedged or there's an exit point. In terms of property, if it's well located, if I know it's a good space, if it's generating rent, I would keep it, to be honest. Because one thing we know is that everyone needs somewhere to live. That doesn't stop just because you have a recession. So what the great thing about a boom is if you've got slightly lower quality assets, or you want to sell a business because you want to retire and so on, that's the time to do it. Because people will be able to borrow lots of money and probably overpay for it. So that's kind of where I that's how I use economic expansions.
Brilliant. Akil, we've got so many more questions. I don't know how much time we've got. Have we got to wrap it up? Got a few more questions. Akil, can you hold on for a few more moments? Because
yeah, it's 6:45 here. I've got all day.
6:45. You got all day. You can head off to the races now. Out to ask it. All right, hang on. Oh God, where were we? Oh, there's so many questions. Here we go. Tony. This is a good question because it's been quite topical in the news. Tony asks, do you see the clogging of $2 billion worth of goods in shipping containers in the US ports what impact will that have on the US economy in 2022?
Yeah, it's a good question. I haven't really ever experienced supply chain issues like this, so I don't really know. I mean, I think the feeling is that it's obviously causing an element of disruption. Shortages are causing inflation and other things, and if that continues for a very long time, that will clearly have more of an effect than people are saying it will at the moment. I suspect what's going to happen is they'll sort it out. And actually, the other thing someone said to me the other day, which I thought was quite interesting, is when we were in lockdown, we all started buying stuff off Amazon. We started buying goods, and there's a lot of goods traveling around the world for delivery. And when we open up, we'll start spending money on fancy coffee and going out for dinner and going to the cinema and other things. And so we'll go from goods to services, and that shift back to spending money on services means that the amount of freight around the world should ease off to a certain extent, which I thought was quite interesting. I don't know if that's how true that is globally or the US, if that's really the cause of or made supply chain issues worse. But I think that's I suspect there is something to it, and so my immediate thought is actually probably it will get sorted out. If it doesn't, then it will cause inflation. If it causes inflation, then of course the Federal Reserve and other central banks will have to take action, which is to raise interest rates, which will bring in a bit of turbulence, as I said in my presentation.
So we're going to expect really another turbulent year. We're still pushing highs in all the markets. All the major stock markets are still on a tear. But we may see maybe some larger swings, in those movements. Is that a fair assumption, do you think?
I think so. I mean, to be honest, I expected the movements in 2021 to be a bit bigger than they have been. And I haven't quite worked out why they haven't been. It's not, people say, well, central banks are flooding the system with liquidity and all this pledges to spend money and so on. That of course is part of the picture, but there might be some other reason. So turbulent periods may be just opportunities where everyone comes into the market and buys the dip and it keeps going up. But certainly the news, I don't think will be particularly kind of even, shall we say. And that has the potential for something coming along which causes markets to have a bit of a moment. Or it might be in certain markets, stock markets might be okay, or the S&P 500 and the All Ords and the FTSE 100 might be fine, but you might see us more significantly in other indices or smaller caps or something. I don't know.
Yeah, one thing I've noticed in the index recently was look like, oh, we're going to have the sell-off, and then all of a sudden all those shorters just got trapped.
Yeah,
short in the hole, and then we just saw short covering all the way for the last 2 weeks. We've just seen a massive big short covering rally all the way back up to the highs. So all those people who are trying to get in short have just been basically handed a slap across the face. So it just keeps going up. But you'd think on the news perspective, it's quite negative what's going on. So it's an interesting world we're living in.
Yeah, indeed. Well, there are some old lessons here, though. Of course, the news is never going to be up to date. And you don't, I suppose the other rule here is that you don't never fight the Fed.
Yes, yeah, absolutely. I think we've got one more question, or there's a fair few more questions, but I'll just take one more. How often has the zero interest rate environment been replicated throughout history?
Good question. So short-term rates haven't been zero, at least in nominal terms, I think ever, or maybe there are periods during the Second World War when they were. Rates have occasionally been negative, so you'd have maybe sort of a positive nominal rate and inflation, so real rates were negative. In that sense, I don't think we're as out of sync with history as we have been. I mean, essentially what low interest rates do is capitalize into higher asset prices. And we've certainly seen that for the last, decade really. I probably didn't say this in my presentation. I meant to. What you tend to find in the second half of each cycle. So first half of each cycle, inflation is lower than the second half, and there are a lot of reasons why that will be the case again this time around. I'm not talking so much about short-term supply issues. When you get a lot of bank lending, in addition to a lot of public investment, a lot of asset price inflation, people spending more money, eventually it does result in fairly sustained inflation, which of course is something that central banks are looking at, and eventually will raise rates. So I don't think we're going to be at zero forever. And that response will be, will come. And in fact, it's often interest rate rises, central banks being usually behind the curve. So they, a bit like the journalists in the news, are behind the curve. It's often central bank rate rises to try and dampen inflation and cool property speculation far too late in the cycle, which eventually brings the peak and then the fall.
Yes, yeah. And just one last question. I know everyone, there's always one gold bug in the
Yes.
in the conference. What do you think will people? What is your advice on gold? I'm trying to read the question. Yes, that's it. With all the political tensions, what's your advice on gold?
So I'm not particularly a gold bug, I have to say. It's a sensible part of your portfolio. I feel that gold probably has a bit of downside at the moment, and so I would wait. But once it does go down, I'll probably buy some more. So gold during the expansions of each half of the cycle, gold tends to follow commodities, though maybe not to the same extent. So I'd imagine that industrial commodities, and if we have bad weather, agricultural commodities will be bigger. Maybe oil, it's a bit difficult to say because just because oil is a bit dirty and we're trying to get away from it. But anyway, gold follows commodity suite during expansion. Where it comes into its own is when people are afraid that the financial system is going to collapse. And you definitely get those fears after the peak of the cycle. So I would hold gold against the expectation of that, but don't expect it to be leading in your investment portfolio until then.
Yeah, it seems to be struggling at around that 1800 level US. It just can't seem to crack that level. So yeah, it's a great question. But Akil, I want to thank you so much on behalf of all of our members and guests on our conference. Thank you so much for your wisdom. How can people get in contact with you if they've got any questions or they want to subscribe or anything like that? What's the best way to contact you?
I will. I'd suggest going onto the Property Share Market Economics website. So it's www.propertysharemarketeconomics, all one words.com. There's a lot of resources there. You can, we've got a free blog, we've got things to download, and also details of either a sort of entry-level monthly publication called Boom Bust Bulletin or a full subscription to PSE. Probably be the best way. You can also find me on Twitter or follow PSE on Twitter as well. Brilliant.
Thank you so much, Akil. And we look forward to meeting up again with you soon, and stay safe. And thank you so much for your time, and have an awesome day.
Fantastic. You too. Thank you very much. Enjoy the rest of the conference.
Thanks, mate.